that can't make it today. So thanks guys for coming. This is kind of exciting for me. This is the first presentation of this type that I've done. So start off with a little bit about me, if I can figure this out. I went to UMass Amherst undergrad. Right now I'm going to BC to get my MBA. Last year I earned my CFA charter, which is a big step for me. That's basically, the CFA means Chartered Financial Analyst, which is for anybody who's an analyst in the field or a fund manager, it's become a pretty essential accreditation. The Series 65 I earned when I was working at Balanced Rock and was thinking about becoming an investment advisor. So really quickly, I'll just say that the difference between what I do right now, I'm in asset management. That's different from it being an investment advisor. An investment advisor is somebody who says, all right, you tell me how much you're making, how much you've got saved up, what are your retirement goals? And by the way, I'll probably send out a summary of just the basic points that I hit on. So don't worry if you don't catch anything. But an investment advisor, you'll tell them what your status is, how much you're making, what your future goals are, and they'll basically form a financial plan for you. So investment advisor is also known as a financial planner, typically. But that being said, I work at an asset management company. We will actually manage the assets once the plan is devised. So you'll say, all right, my goal is to retire and draw down 4% of my savings a year forever, or 10% of my savings a year until it runs out. And we'll just actually buy and sell companies with the goal of making that money grow. So what is investing? I think that the term investing or investor can be kind of intimidating for people who don't have bags of money sitting around. And that's a big misconception, I think, is you don't need to be super wealthy to be investing. Basically, investing is taking money that you have and buying assets with the goal of helping that money appreciate and grow over time. And specifically, the ways that you can do that in the public markets are to buy stocks and bonds. We'll get to that in just a second. So I want to touch on a couple basics in the investment management profession. I'm an analyst. As I said, I work at an asset management company. My job all day is to research companies. What I'll do is I'll look at their public filings, their government regulated filings. You've probably heard of a 10K, which is an annual report for a company, or a 10Q, which is a quarterly report. And they'll also issue press releases and other public data now and then. So I'll do that. I'll listen to the conference calls. I'll construct and analyze spreadsheet data based on their financial reports, and then I will submit a report to the fund managers or the portfolio managers that I report to. Fund manager and a portfolio manager is two words for the same thing. There's a lot of synonyms in the financial profession, which I think can be confusing sometimes. But what a fund manager or portfolio manager does is they will take the research that is done by analysts, they'll do a little bit more work themselves and make the final call on whether that new information should be acted upon in the form of a buy or a sell. So you've probably heard of mutual funds. Fund managers are basically making the final call on what should or should not be held in the mutual funds that they're managing. Now, once they've decided that, they'll call down in a large organization, they'll call down to the trading floor and they'll instruct their traders to place that trade. In a smaller organization like the one I work for, the fund manager is the trader. So they'll go out and say, hey, I'm interested in selling 1,000 shares of Amazon or whatever. And they'll send that out into the world. Typically, they'll go through a broker, or they'll find a broker to be their counterparty. So you've probably heard of buy side and sell side. Buy side basically means asset managers, people who are buying securities on behalf of investors, whether that's individual investors or corporations or trusts or whoever's money they're investing. Sell side would be brokers or investment banks. So you've probably heard of JP Morgan and Goldman Sachs, Merrill Lynch, Morgan Stanley. They're all sell side. They are working on behalf of companies to make markets for and sell securities of those companies. So recently, Boeing issued $25 billion in debt, which was a huge debt issuance. And they went through a number of investment banks, which are the sell side, who helped them raise that money by going out to buy side investors, which you'd probably think of Fidelity or BlackRock or Vanguard or State Street. You know, they're all managing assets for investors. So a couple other fun things that you probably heard. A day trader is not a professional role. You will not be hired by you won't be hired by a company to be a day trader. A day trader is somebody who trades on their own behalf and they trade frequently. A quant or a quantitative analyst or a quantitative fund is rather than, it's kind of a dichotomy between fundamental analysis, which is a lot more what I do right now, where you're actually looking at the fundamentals that are underlying a business and deciding, is this a good business to invest in? That would be fundamental analysis. Quantitative is just looking at the numbers strictly, and that includes how the price of shares have been moving. Anything that's numeric is quantitative. Quantitative versus qualitative. And then a hedge fund, I think, is a misconception. A hedge fund is not a type of investment. It's not a type of investing. It's just a fee structure around many different types of investing. So typically with a mutual fund or an ETF or an index fund, which I'll get into a little bit more later, those have fixed fees that are a specific percent of the assets that are within that fund. A hedge fund would go to investors and say, look, I'm wicked smart. I can beat the market, and I'm going to do it this way. I'm going to buy small companies entirely. I'm going to reposition them, and then I'm going to resell them, and I'm going to make a huge amount of money. Or they could say, I'm going to be an activist investor. I'm going to go in, I'm going to buy 5% of a stock. I'm going to yell at the management until they make a few changes. The stock will go up 20% and I'll sell it, and you'll make a bunch of money. And those are just a couple examples. And hedge funds aren't inherently bad or good or anything. They're just an asset management company that has a specific fee structure, and that's referred to as a management fee plus an incentive fee. So a 2 plus 20 would mean they're taking 2% of assets under management, plus if they make $1 for you, they get to keep 20 cents of that. So for the very successful hedge fund managers, it's worth investing in their funds. But the fees can be very expensive, and it's very difficult to outperform the market because of that. And there's been a lot of research into passive investing and why that can be a better alternative. And again, I'll get into that a little bit later, but just wanted to touch on what a hedge fund is. So the basic building blocks of investing are, at least in the public markets, are stocks and bonds. Stocks also referred to as equity, is an ownership position in a company that is denominated by shares, and those shares are given a price. So, for example, Apple has a price around $300 a share, and they have 3 or 4 billion shares outstanding. You take the price of the shares and the number of shares, and you multiply those, and you get the valuation of the company, also referred to as the market cap or market capitalization. So for a company like Apple, they're around $1 trillion company because they have so many shares outstanding and each share is valued at so much. Now you can be a part owner of that company. You can buy a share or multiple shares and you will own a piece of the pie in that company. So whether you refer to that as stocks or equity or shares in a company, you're basically becoming a part owner by buying those shares. And it's kind of a cool feeling to own shares in a company and look at it as, I own a piece of that company. Fixed income, on the other hand, also referred to as bonds, also referred to as debt. Again, like I said, there are a lot of synonyms in the financial world, so don't be confused if somebody says bonds. It's the same thing as saying debt. But you've always been taught that debt is bad. Well, a lot of companies raise debt because they need to fund capital projects or expansion or whatever. So bonds can be issued by a number of different people. People's the wrong word. They can be issued by companies. Those are called corporate bonds. They can be issued by governments. Those are called government bonds. Or in the case of the US, they're called treasury bonds. In the UK, they're called gilts. You don't have to worry about that. Or there could be municipal bonds. So the city of Boston could issue a bond with the intention of using those funds to build a new wing of Logan Airport. So basically the three types of entities, that's the word, that could issue bonds in the public markets are companies, governments, or municipalities. The difference in returns of what you can earn on stocks versus bonds, for stocks, you'll earn money based on the appreciation of the price. So let's say you buy a stock for $10, it goes to $20 over the year, you've just made $10 on that stock. You have to sell it though to realize that gain. Otherwise it's just sitting there in your account, it's just a number, and if it goes back down over the year, you didn't actually make any money. Companies will also issue dividends. So if you look at the dividend yield on a stock, let's say it's 2%, and you just bought the stock and it's $100 stock, it's got a 2% yield, that means that you will earn $2 in dividends that's just paid to you in the form of cash over the year. That just goes to your account, you can do whatever you want with it. Not all companies pay a dividend, and you'll probably hear the difference between growth stocks and value stocks. Growth stocks typically are not paying a dividend. They're reinvesting all of that cash. And a lot of companies that are referred to as growth stocks are actually losing a lot of money. And I've talked to different people in my profession, and some of them actually love companies that are losing money because they're reinvesting more than they're making, which means that they should be positioning themselves for more explosive growth in the years to come. In some cases, that has been the case. You saw that with Amazon for years and years. There are a lot of really successful companies that have reinvested all those earnings, lost money for many years. You're starting to see that with Tesla, which is an interesting case, which I could talk to you one-on-one about sometime. We don't invest in Tesla because the valuation's crazy. But anyway, this is the kind of rabbit hole that I'm going to get sucked down. There's growth stocks, and then there's value stocks, which would have higher dividends, meaning that they're typically slower growth. So you see something like, I don't know, a Colgate they are not really going to be selling a ton more toothbrushes year to year, or toothpaste. That's a pretty static market. So instead of trying to reinvest in order to sell more toothbrushes, they're going to start paying out that cash that they're earning in the form of a dividend. So those are two categories of stocks: growth and value. They're not official. They're kind of denominated by the industry. With bonds, on the other hand, with bonds, on the other hand, you will get returns based on two things. You will get an interest rate in the case of corporate bonds or municipal bonds, which means that when you give them your money, well, let me take a step back. With a stock, the market sets the price. The price can be $10 today, $9 tomorrow, $12 the next day. The market moves the price of the stock. In the case of fixed income, the market will also move the price of the bond, but in most cases, to a lesser extent. And that's because if it's a company that has a good reputation and a good financial statements and are able to pay back that debt at the end of the lifetime of that debt, then why would anybody be selling it for less than it's worth? So you'll hear something called the par value, which is if you buy a bond for $100, the par value is $100 that you'll receive at the end of the bond's lifetime. Let's say it's a 5-year bond. They'll issue it for $100. You can buy it for $100, and they'll pay you maybe 3 or 4% a year for the next 5 years. And at the end of 5 years, you get your $100 back. It's not like stocks, which you hold until you decide to sell, or if the stock goes bankrupt, which are the only two exits in a stock. With bonds, there's a fixed point of exit, and that's when it matures. So the only other source of returns for bonds is if the bond is trading at a discount or a premium to that par. Let's say it's $100 par, and you can buy it at $99. You'll get the extra dollar in income when the bond matures. Again, hope you're following me. If you didn't follow any of that, don't worry about it. I'll send out a simple summary at the end. Now, you've probably heard of different exchanges: the New York Stock Exchange, which is the NYSE, the NASDAQ, and then there are foreign stock exchanges, the London Stock Exchange, the DAX, which is in Germany, the Nikkei, which is in Japan. Basically, every country has one or multiple stock exchanges. A stock exchange is something that a company will list their shares on, meaning if they want to go public, they have to be listed by one of these exchanges. It's just a trading platform is the wrong word, but it's a trading exchange. I don't want to just use the word exchange again, but it's just in order for a company to be public, it has to list its shares on one of these exchanges, and it pays money to do so in the form of a registration fee. Now, there's also things called indices or an index. You've probably heard of the Dow Jones, the S&P 500, maybe fewer of you have heard of the Russell 3000. Those are groupings of stocks that are listed on exchanges. So the Dow Jones are the 30 biggest companies that are listed on US stock exchanges. So, you got Microsoft, Amazon, Apple, etc. S&P 500 are the 500 biggest stocks that are listed on the US stock exchanges. Russell 3000, the 3,000 biggest stocks on US stock exchanges. And just like you have American indices, you also get indices of all these different exchanges all over the world. So the FTSE 100, FTSE 100, it's referred to as the FTSE, is the 100 largest companies listed on the London Stock Exchange. The DAX 30 would be the 30 largest stocks on the German, well, specifically on the DAX, which is one of the German stock exchanges. The Nikkei 225, the 225 biggest companies listed on the Japanese stock exchange. So it's important to understand the difference between what an index is and what an exchange is. An exchange will include a huge number of companies, and it's just basically a platform for these companies to be public companies. An index is a specific segment of companies that are listed on exchanges, a specific segment of public companies. And that's divided, as I mentioned with these ones that are on the screen, those are grouped by size. But there have been a lot of indices that have been created over the last decade or so that have much more specific criteria. And around those, there have been index funds and then ETFs that are created. So a little bit more on that in a moment. You've probably also heard of IRAs, 401ks, individual accounts. Those are not investable assets. Those are your accounts. That's the name of your account. Excuse me. An IRA, a Roth IRA, and a 401k are all tax advantage types of accounts. So that means that in the case of an IRA or a 401k, actually a 401k can be either a regular or a Roth. In the case of a regular 401k or an IRA, it means that you're contributing cash from your paycheck before it's taxed. And at the end, when you start to withdraw those dollars, once you're into retirement, it'll be taxed then. So they're particularly useful for people who are paying in a high tax bracket now, or for people who expect that maybe tax rates in the future will be less than they are today. In the case of a Roth IRA or a Roth 401k, you are putting money into that after tax, but it's not taxed. That's an important distinction. It's not taxed ever again. In the case of an individual account or a brokerage account, which you could open and it has no deposit limit, that money is, say you've saved up a bunch of money, it's on the side, you've already paid income tax on it, you can put it into that account, you can buy and sell securities. But okay, you bought Apple at $100, it's up to $300, you sold it. You're gonna have to pay taxes on that $200 gain that you realized on Apple stock, unless it's in an IRA. In the case of a Roth IRA, you have post-tax dollars, you've already paid income tax on that, and if you recognize a gain on a sale, you're not paying tax on that. So that's particularly useful for people who are in a low tax bracket. I would suggest that, for people my age or people who are not earning income in a high tax bracket, to open a Roth IRA or a Roth 401k, because it's a good way to, especially tax rates are very low right now. Obviously, that was a political policy enacted by the president last few years. So there's a lot of advantage to be had potentially if tax rates go up in the future, because you're not going to have to pay that. Anyway, again, that's a further discussion that I can have with you one-on-one if you're curious. Joint accounts means, all right, I want to have an account with my sister or with my uncle or with my grandmother, and we're both going to be on the account. That's just a different types of tax. That's a different type of taxable account or a brokerage account. And then a trust is an account that you can put in somebody else's name. So it's typically used in estate planning if somebody is trying to build an account so that their assets will transfer to their children or their grandchildren or great-grandchildren or what have you. So those are all different types of accounts. So you can't buy an IRA or a 401k. There are different types of products as well. So I mentioned this with the indices. Mutual funds. First, let's start with passively managed. A passively managed mutual fund means that the stated goal of the fund is to track the index. So you'll see a SPDR ETF or something, that's a State Street. I think that's the biggest one in the world, is basically just all of these different funds that can track an index. So like I said, the Dow Jones is the 30 biggest companies on the US stock exchanges. There are many, many index funds that track that. And what that means is they own all 30 companies in a similar proportion to what the index says. And the whole point is you can watch the Dow Jones move day to day and be like, all right, my passive investment in that index fund is doing exactly what the Dow Jones is doing. And it pretty much does, except that they charge like a small fee, which is usually nominal, and you really won't notice it too much over a course of years. The issue with a lot of ETFs is that they have gotten to be very specific. And that's because, like a lot of other things in the financial world, they've become a product. So you'll see, like I mentioned before, there are growth stocks, there are value stocks, and then there are different market cap sizes. So large cap means over some nominal amount. So maybe any company over $5 billion or $10 billion in market cap is a large cap stock. Anything between 2 and 10 is a mid cap stock. And anything under $2 billion in valuation is a small cap stock. So they can segment it and break these exchanges or indices into all these different categories. And then they can say, all right, that's a new index. We'll make an ETF out of it, and we'll sell it to all of these American workers. And a pretty critical, oh, hold on, Jesse's here. I'm just inviting Jesse in. It's not working. A pretty critical change that happened was the shift from defined benefit funds to defined contribution funds. And I don't think that most people are really aware of that. What used to be the case in most American companies is that you'd have a pension, basically. And a pension is the same thing as a defined benefit plan. That means that if you work at the company for a certain number of years, you are going to be given some multiple of your final salary or average salary at the time you retire. Those plans, a lot of companies saw them as a huge liability. And so over the past couple decades, there's been a giant shift in almost every American company away from those pensions, those defined benefit plans. Instead, they're defined contributions. So you hear about a match. Okay, I can contribute 4% of my salary to my 401k, and my employer will match that with 4% or 2% or 1% or whatever. But now it's on you to manage that money. And since financial literacy is so low in the country, there were rules established that, all right, if you're going to set up a defined contribution plan, you have to have a certain number of options. So it's become this whole new industry where there are companies that create all of these index funds, all of these ETFs, and they'll go and they'll sell a package of those, because I think you have to have like 6 or however many different options for your employees. And they'll say, hey, here, I have this set of ETFs. Look, there's one that's a global ETF. There's one that's American small cap, American mid cap, American large cap, whatever. They've got this whole package, and it's a sales pitch. And once an employer agrees to that, and this is usually typical of larger businesses, mid to large size businesses, you'll have your 401k, but it's very specifically, you can only invest in those fund options. So that's been, for me, that's been a particularly frustrating thing to see is typically they're not great options, and they've got all these different fees, or they're not being run super well. And I have yet to see a group of options in a defined contribution plan that has outperformed or even met the market. If you have a defined contribution plan, you can't really do anything about that, and You can really only move it out into something else if you change jobs. So anyway, those are passively managed, and I don't want to speak ill of all passively managed. I think that index funds themselves, if they're of the Dow Jones or the Russell 3000 or the S&P, the biggest index funds are generally just tracking the major indices, and those are fine. You'll get a return that's average. You can follow the market daily, and you can see the major averages, and you know what your portfolio is doing. And there are generally low fees, especially with Vanguard. I don't know if you've heard of Vanguard. John Bogle started Vanguard in 1974 and created the first index fund in 1976, and they run trillions of dollars worth of very low cost, passively managed index funds. So that would be my personal suggestion if you want to go that way. The other option is actively managed mutual funds or portfolios. So traditionally, there wasn't the option to invest in an index. Traditionally, your only option was either you could buy and sell stocks yourself, or you could pay somebody else to buy and sell stocks for you. And that would be an actively managed account, is you're making the decision of what to hold in that account, rather than a passively managed fund, which is there's a set of rules and that fund follows a set of rules. Now you can have some loose rules for actively managed accounts, but you're still making the final decision what to include, what not to include. That I spent a lot longer on that than I thought, so I apologize if this is taking longer. But then you've probably also heard of annuities. Annuities, I am very anti-annuity because there are massive fees charged, and typically the appeal of an annuity is, say somebody, and I'm just using this because it's a round number, say somebody buys a $1 million annuity. What an annuity is you give us $1 million and we'll give you $50,000 or $100,000 a year every year once you turn 75 or whatever that age is. You know, there are different criteria of when they'll start paying you out, how much they'll start paying you out, and it's all based on a certain rate that they'll give you. But that rate is coming from them taking that money and investing it themselves, usually in an index fund or in some safe set of bonds or something like that. And they're also charging a lot of fees up front. So for me, the thing that turned me off about annuities most was when I found out that the typical fee charged up front, called a front load fee, is 3%. So let's say I was selling an annuity, which I don't. If I sold you a $1 million policy, I would get $30,000 on day one in my pocket. And I don't see how that can be good for anybody that buys an annuity if you're paying $30,000 to the person who just sold it to you. It's a clear conflict of interest, and I think you should try to avoid that as much as you can. And I could get into the conflict of interest a little bit more, maybe in a future discussion. There's also a lot of insurance products like life insurance. There's all these different kinds of life insurance. I don't know a ton about insurance products, but in some cases they're okay. They're very useful. And there's actually some tax planning benefits to them that an investment advisor could advise you on. Because in some cases they can be quite useful. One more slide. So you really, when you're investing, have two options. You can do it yourself. Again, you can invest in passive funds, you can invest in active funds, or you can make your own trades. Now, to do that, you really should do your own research. And you don't necessarily have to do all of the research that I would do on a daily basis. That's really not realistic for most people to spend, however many hours a week looking into and reading all of these public filings and conference calls from public companies. But the research is out there, and I'm happy to share different resources for you if that's something that's interesting to you. And I really encourage you to, pick your favorite company and go and read their annual report, and you'll actually learn a lot about the company. I mean, I kind of nerd out and enjoy reading those things, but it's also very educational. So from that, you have to also form your own opinions. And I think that's a big misconception. There's not one right price for any given stock. And that's what creates a marketplace. You know, everybody can do the same research, can read the same filings and listen to the same conference calls, and can arrive at all these different conclusions because you have different assumptions about the future. And that's okay. That's actually really good and healthy to have your own opinions about what you think will occur. You know, do you think that this is the end for closed malls? Like, you know, is Simon Properties going to go bankrupt, or are they going to find a new way to use that space and find new tenants? You know, that's everybody has different opinions on that. There's not, I mean, there will be over time a right answer, but you can't know now what the future will hold. So you have to make your own assumptions when you're doing investing. But also, like I mentioned before, with day trading, that's not necessarily investing. When you're investing, you really have to be thinking for a long-term time horizon. Is this company going to be good 5 years down the road, 10 years, 20 years down the road? If it's a company that you think could go bankrupt at any of those time frames, if you're reasonably sure that it will, and you're just going to buy it at 10 to sell it at 12, well, why do you think it's going to go to 12? That's not necessarily investing. That's more of a little bit of a gamble and what people will refer to as a trade rather than an investment. Also, if you do build your own portfolio, it's important that, like the indices, you have a certain number of investments. You really need to diversify. And diversification, by the way, this slide is probably what I'll get into on a more granular level next week if I do hold another call. Diversification is incredibly important. You don't want to put all your eggs in one basket, because no matter what the company is, there could be something that comes along that is unexpected. That, you know, there are all of these stories of companies that people thought were invincible, and then the world changes. You don't want to be stuck with just one company. So if you're diversified among a number of companies, I think that number has been pretty commonly agreed upon as anywhere from 20 to 30 companies, you're at least diversified somewhat. And that doesn't mean that you own 20% in one company and then you own 19 other companies. You want to own a fairly diverse group of companies if you're going to be investing and not taking on too much risk in your portfolio. Now, that's if you do it yourself. The other option is that you can hire somebody else. And that's really what a financial advisor or an asset manager or a registered investment advisor would do for you. They'll take your money and invest it. Again, I'll probably speak on this more next week, but it's very critical that you understand what their fee structure is, understand what their conflicts of interest are. And there's actually the SEC, which is the oversight board basically for the financial industry. They have issued a new requirement where people like, companies like mine or anybody who would be managing assets, they have to now put together this 2-page document that explains, all right, here's what I'm doing for you, here's how much I charge, here's what my conflict of interests are. And I think that's a really nice new mandate from the SEC, because there's really a lack of disclosure from a lot of people. And there are a lot of hidden fees where there shouldn't be. So, this is a legal requirement that all of these fees need to be disclosed. You need to be sure that if somebody's managing your money, that they're a fiduciary. This might be the first time you've heard that term, but a fiduciary is somebody who is legally required to put your interests ahead of theirs. Believe it or not, not everybody that runs money has a fiduciary duty. And those people are probably not going to disclose that. You should also be sure that they're fee only instead of fee based. And typically fiduciary and fee only is on the same playing field. Fee only means I'm going to charge you a fee for managing your money. Fee based means I'm going to charge you a fee for managing your money. And by the way, if I put this ETF in your portfolio, they're going to give me $500 for putting you into that portfolio. You know, there are shady arrangements like that. And you just got to watch out for the terminology. And it's very close, fee only instead of fee based. You just have to be careful of that. Also, you don't want to be paying somebody 2%, 3%, 5% fees, because you're never going to be able to overcome that. Not that you're going to necessarily lose money, but if the market over the course of the last 80 years has on average returned, I think it's 9.8% for the S&P 500, if somebody's charging you half of that, you can't make up that difference. So fee structure is very important. And I think 1% fee is very common. Anything more than that is a little egregious, unless they have a track record of delivering outstanding returns, which very few companies do. I think that's about it. And I am happy to take any questions right now. I think we had a few in the chat that came up. So again, thanks guys for taking the time to listen. I think that took about 40 minutes, where I was thinking it would take maybe 20, but I could talk about this stuff literally all day. So I hope that you all feel comfortable to send me a message or give me a call and ask me any questions if you have them at any point. So let me first address any questions in the chat, and then I'll unmute you guys, and you can ask me some questions like that. Can companies be listed on multiple exchanges? That is a good question. So they wouldn't be listed on, say, the NYSE and the NASDAQ. Typically, a dual listed company would be listed in different countries. So there can be a company that's listed on, say, the Paris Stock Exchange and the New York Stock Exchange. And they're two different classes of shares. You'll typically hear something called an American Depository Share or an American Depository Receipt. Actually, a lot of Chinese companies have done that because the access to the capital markets in the United States there's a lot of money here. So a lot of people want to be listed on the New York Stock Exchange or on the NASDAQ. And actually, you'll see that a lot with Canadian companies as well. So yes, they can, but not within the same country. Let's see. Can you review the tax benefits of a traditional 403B? So I don't know a whole lot about 403B plans. I know it's tax advantage, and I know that it's specifically for kids' school funds. So whether that's tuition or books or whatever. Again, I'm not an investment advisor. I'm not a financial planner. So I have like a basic idea of what it is, but I don't know how it works. I can find you resources and people to talk to who would know what it is, but I can't really expound upon the tax benefits of it. Especially, I'm not a tax expert, unfortunately. Tien, how do I start investing in a Roth IRA? So again, you don't invest in a Roth IRA. A Roth IRA would just hold money, and then in that Roth IRA, you can make investments with the money in there. But you can open up a Roth IRA, I think, at any time. And then it would just come out of, the money would filter from your paycheck into that Roth IRA. But you can open it up and I can get you the paperwork, or you can go online to Charles Schwab or to Fidelity or whoever, and you can open a Roth IRA. A 401k, on the other hand, has to be opened by an employer. So that would be the difference between an IRA versus 401k. Yeah, so 401, again, Sarah asked, 403B, again, that is like a savings account that would specifically go towards educational funds for your kid. There are some tax advantages, but I don't necessarily know them. A 401k, though, is opened by your employer. And again, getting into the accounts more specifically, I have people that I work with who deal with the account openings so that I don't have to, because it's not my area of expertise. But I'm happy to get you more resources about that. So I'll get those to you too. I'm always Rich. I'm always happy to give free education. I think I'm kind of naturally education is kind of a passion of mine. So especially with in finance, it's really an undereducated populace, and I think if I can do anything to help that, I'm really happy to put myself out there and offer my time just to help people learn or at least discuss questions that they might have. Nick, if a company is purchased, such as LinkedIn being purchased by Microsoft in 2018, what happens to LinkedIn shareholders? So in the case of an acquisition, which is what that was, the acquisition will be made either for cash or for shares or for a combination of cash and shares. So let's say in the case of LinkedIn, I think that was a $28.2 billion acquisition. That might have been paid by Microsoft in all cash, which means if you were a shareholder of LinkedIn, by the way, this is theoretical because LinkedIn was a private company. But if LinkedIn was a public company, and if you were a shareholder, you could be getting all cash, or depending on the terms of the agreement, you could be getting shares in Microsoft, or you could be getting some cash and some shares in Microsoft, or in some cases, you get the right to choose. So it depends, but you'll either get cash or shares in the parent company that will be taking over. 403B is through employer. Okay, maybe I'm wrong about 403B. Maybe I'm, again, not an account expert. Not my area of expertise, unfortunately. But I do know the basics, I think. How should I approach investing in the current environment? Should I wait for things to settle? That is a very difficult question because you can't know what the future holds, but you can make assumptions. So for me, I think it's there are a range of possibilities right now. And you're seeing a lot of new developments coming out every day. And you're seeing a lot of, smart people on both sides of the fence. When you're investing, if you're buying specific companies, you should be buying them in a combination of what that you expect them to be bigger and better and more prosperous in the future, but you should also be doing it at a price that you think is reasonable. So again, it's really important that you have to make that educated guess. Where are we right now in the cycle? Is the coronavirus going to come back and affect the market in the next several months, over the next year or so? Maybe. But we don't know that. So the market could do a number of things over the next 12, 18, 24 months, and it could do a lot of things over the next 5 years. Will there be something else that comes in and happens? There are unlimited variables that you can't measure every variable. So you have to just make some basic assumptions and say, am I comfortable with the price of this company now? Do I think this company is strong enough to make it, given my assumptions that, all right, the next 12 months are going to be difficult? Yeah, they've got plenty of cash and they're actually still making a profit now, even in this tough environment. Some companies are. A lot of other companies are losing a ton of money. And for some, the business has changed entirely. Airlines are one example that, at what point are people going to be going back and riding on airplanes the same way that they did before? That's a very different business now, especially because they have to issue so much debt and so many new shares in order to fund themselves to get through this period. So again, I think it's really hard to just blanket statements say, yeah, you should invest now, or no, you shouldn't invest now. For me specifically, I'm looking at a company by company basis. So there are some companies that we've looked at over the last month that are great companies and that the prices come down along with everything. And in certain cases, yes, I think there are a lot of great values out there. So I think in a lot of cases, I would be buying now. Does that mean you should go out and buy everything right now and put all your money into the stock market? No, you should probably hold some cash, but you can go out and find companies that you think are great that might be at cheaper prices now than over the past several years, that are going to be fine coming out of this. So again, I think you could see it both ways. If you're going to wait for things to settle out, you have to be okay with the possibility that things could go up 10, 20, 30% over the next however many months, and you could miss out. And then on the other hand, things could decline 10, 20, 30% from now over the next 12 months or 24 months. So you just have to say, maybe you want to invest a little bit at a time and just spread things out. It's all about what you're comfortable with. And that's really a very critical point when you're investing, is you have to be comfortable knowing that the market could move in any way tomorrow, over the next week, over the next month, over the next year, over the next 10 years. You don't know what the market's going to do. You can look at what it's done historically. You can look at the fundamentals of the companies in it, but there are so many variables that you can't account for and so many circumstances that you don't know will yet occur. So you just have to be okay that if you invest now and it goes down, that's okay. Or if you don't invest now and it goes up, that's also okay. You have to make that call. And again, I probably spent a few minutes on that. We can have a longer discussion about that too. Jesse, thanks for saying that. I think he headed out. Have I analyzed Boeing's fundamentals, listened to their conference calls lately? I will say a couple years ago, I analyzed Boeing and I thought, what a piece of crap. And then it went up from $200 to $300 and I felt like an idiot. And then it went down to like $80 and I felt like a genius. So, I mean, they've got a lot of problems. If you want to talk about Boeing specifically, they have so much debt on the balance sheet now that it's going to be a lot harder for them to have success, especially with the 737 Max. And I mean, it's not something we're buying for sure. It's not something I would ever buy because of their balance sheet and because of the problems that they had. When you talk about the 737 Max, that just shows a lack of, when you invest in a company, you really want to be sure that you're investing in a company with a good corporate culture. If the corporate culture there was such that they just overlooked problems that they knew were there for profit, you don't probably want to invest in that company unless you don't really mind that kind of thing. But over a long time frame, that's generally going to cost them a lot of money, whether that's in fines or they're just ignoring problems in the general underlying business. So definitely would not recommend buying Boeing. But again, that's a personal opinion. That's an educated opinion, but it's a personal opinion. Kids need to learn to balance a checkbook. Yes, absolutely agree. And I think that I've thought about that a lot and how I would like to probably work with kids in some capacity to teach them this, because I think by the time you get to your, a certain age, you've made a lot of mistakes that you could have been investing early on, or you could have been working on your credit or knowing how to balance a checkbook. Like those are all incredibly valuable just to life, and it's just not taught in school. So I've thought about that a lot. 2TN, what is the safest type of investment? CDs are not a good investment. They're not an investment. They're just a store of cash. The safest store of cash would be, I don't know what just happened to my screen. The safest store of cash would be an inflation-adjusted treasury bond. But a lot of times when you're investing in something that's super safe, you're giving up a lot of upside. So if you're investing in an inflation-adjusted treasury security, you're gonna earn right now, geez, I don't know, 1%, maybe less than that a year. So no, CDs are not really an investment. They're more of a store of cash, and generally, I think that my opinion is right now, that's basically the case with a lot of government bonds, is they're more of a store of cash. Would a bond like that even be keeping up with inflation at 1% a year? If it's so that's the thing with treasury bonds right now, is the 10-year yield is like, 1.5% or something. Geez, you're going to get 1.5% for 10 years. You must really think the market's going to do crappy if you don't think that over the next 10 years it's going to return, whatever that would be, 20% or something. Basically what that is you're going to be investing in treasury bonds if you just need to earn a little bit of money on cash that you need at some point in time soon, and you don't want to lose that money. So let's say you're planning on buying a condo in a year and a half. All right, you can go out and buy government bonds or put it in a CD that has a year and a half maturity, and you know that money is just going to earn maybe 1%, but that's okay because you need that money for a down payment in a year and a half. But if you're looking at a long-term time horizon, for that to be worth it, the market has to really underperform that, and that's typically is not the case. So when you're talking about investing, you really should be trying to invest in mostly stocks if you're actually trying to grow that money, understanding that it does carry a certain degree of risk. So how can you get a treasury bond? So first of all, you have to open an account, and then once you open an account, you can go on Fidelity or Schwab or whatever it is and go to trading, and you can have somebody help you out with it. You can call their customer service and say, hey, I'd like to buy a treasury bond or this stock, and can you buy me one bond, which is, by the way, bonds are typically traded in $1,000 increments. So you could say, all right, I'm going to buy one bond for $1,000, or I'm going to buy 100 shares of this $10 stock, or whatever it is. But once you set up a trading account, whether that's a 401k or Roth or an IRA or an individual account or whatever, then you can buy and sell securities in that account. So that is it for the chat questions. No, there's so many companies out there where people can hold their money. Fidelity, Schwab, etc. Do you have any recommendation? Yeah, Schwab I have experience with, and I know that it's a very easy to use platform. It's pretty intuitive. They have great customer service. Fidelity, I think, is a little bit more salesy, like Fidelity, they'll in my experience, I have a personal account at Fidelity that I haven't traded with in years, because that was where I first started. My investing career was just trading on my own at Fidelity. And I found that it was they give you a lot of their own research, and they try to sell you mutual funds that they have on their own, and they've got, all right, here's our rankings of these companies and blah, blah, blah. Schwab, it's kind of like, all right, if you know how to do the research, all we are is a platform. So I would recommend Schwab. Fidelity's okay. No complaints there. Yeah, for sure. Schwab is more self-directed. It has, in my experience, it is. I mean, Fidelity is also self-directed, but I think that I think they try to give you a lot more research. Robinhood, I would recommend not to do. So here's the thing about Robinhood, and that actually brings up a really interesting discussion. Robinhood came out a few years ago, and their thing was no trade fees. So okay, awesome. You can go onto Fidelity and pay $5, or you can go onto TD Ameritrade and pay $5 to buy one stock, or you could go onto Robinhood and pay $0. Whoa, that sounds great. I'll go on Robinhood. And at the time, it was revolutionary. It was a really great idea. But within the last 18 months, maybe even within the last 12 months, all of those companies, or almost all of those companies, have dropped their trading fees to $0. So there's really no benefit now for Robinhood to use Robinhood as a platform, because actually their execution is terrible. I've tried out Robinhood, and I put in a purchase at, I was looking at the market and I said, I like this price, and I put it in, and the price I got was like 2% higher. It was a really terrible execution. So it cost me just as much to get a bad price from them as it would have to pay $5 for a trade fee at Fidelity or at Schwab. And now that Fidelity and Schwab and Ameritrade don't have trading fees, they execute the trades right away, and you know that it's legitimate. So not that I'm calling Robinhood illegitimate, they just have bad execution. So I would recommend not using Robinhood because there's really no advantage. It's just a disadvantage, I think. Katie, I don't really know My Merrill. I have no experience with My Merrill. It might be fine, but I can't say one way or the other personally. But Katie recommends My Merrill as a platform. Any thoughts on Vanguard? Vanguard is generally really good. Again, I would recommend if you don't want to be actively managing your portfolio, if you're okay with just saying, I'm going to have the market return. And by the way, taking an active view and managing your portfolio in an active way, you do that because you believe that you can achieve above average returns. If you aren't really worried about that and you're okay just saying, all right, I'm just going to do whatever the market does, I'm just going to have an average return, then Vanguard has funds that are some of the best in that. You should just make sure that they're, buy their S&P index fund or their Dow Jones index fund or whatever, rather than, even they have come up with a lot of segmented new indices. They're doing it a little bit more selectively than others who just say, here's like a ton of different options of ETFs. They're a lot more selective in what they're getting into, but they're still getting into it. But generally, I think Vanguard's great. They have very low fees, which is good. I think some of their funds are like less than 0.1% fees, so you really don't even notice it. Can we talk puts and calls? Puts and calls are a little bit more advanced in terms of actually how you would do them, but everything I've talked about so far is about going long. So the two options I presented are basically buying or selling. Puts and calls, again, are a little bit more complex, where you're basically taking a position on where you think a company's going to move in a short time horizon. Generally, it's really difficult to make money on those because they're priced incredibly well based on all of these technical factors. And really, the people that make a lot of money on puts and calls are the ones selling them, not buying them. If you want to speculate in the stock market, if you want to be a day trader, then you can buy puts and calls. But really, the only legitimate good use of puts and calls is hedging. If you're really worried about a downside event, but you don't want to sell a position and realize a tax gain or something like that. So there are some cases where they're really useful for that, but generally, they're short time horizons. They're kind of speculative. Take on Wall Street Bets. I don't know what that is. I see that's Reddit Wall Street Bets. I don't know that. I'll have to take a look at it. Thanks for bringing it up. Yes, Rich, you get the perks of no trading fees with the resources of the bigger players. And the reason that they're not charging a trading fee is they've realized, we've got all these other services, like we can make money off of the cash account that's sitting in their account, or we can make money off of, all these other fees and products that they can sell. So Schwab has their own mutual funds that they'll sell you on their own platform, and Fidelity has the same thing. And I don't know. There's no reason for them to charge trading fees. It was such a small portion of their revenues. For an average Joe like myself, are there certain accounts, bonds, et cetera, that I should be looking into and asking about? Yeah, I think if you are interested in doing the research and learning more about the stock market, I super highly suggest just pick any company that you really like, search on Google, search for their annual report, read the annual report, and it's a huge education. And it could spark something, or you could just be like, this is super boring, I have no interest in this. And in that case, I really would recommend either finding an investment advisor who can discuss it with you if you're interested in that, and invest your portfolio for you, or just invest in an index fund, in a passive index fund like the S&P 500 index fund, or Dow Jones investment. That's totally fine. So it really depends on your level of interest. But yeah, I'd be very happy to discuss that more about you, more with you. Discuss that, whatever. Interesting and good to know how Wall Street bets. I really don't know what Wall Street bets are. Still don't mind decision. That was pretty good at long division. Any major differences between ETFs at the major providers, Vanguard, State, Schwab, etc.? Yeah, a lot of ETFs are issued by those guys, but also by a lot of smaller guys. And the real difference is, first of all, in a lot of cases, the fees are kind of hidden. I've seen ETFs where they charge like a 4.5% fee for you to buy into the ETF. So, if you're going to invest in ETFs, you really should be aware of what the fees are. That would be the main thing. And then also try to understand how they're constituting that ETF. What is the index that they've created? By the way, they've created these indices. What's the index they created, and what are the criteria of what something is that go into that? A lot of them, though, the big guys, a lot of them have just the same ones. So really only the difference would be like the fee, or to some small degree they're going to differ, but they'll generally perform pretty similar as long as they're tracking the same index. All right. Well, I hope that was helpful. I'll unmute everyone if you're interested in saying anything or having any questions.
Great work.
Yeah,
Thank you.
Thanks.
Thanks, Elliot.
Thank you.
Well, I hope that was.
Thanks, Al.
I hope that wasn't just a lot of words. And
Great. No, that was awesome. Thank you.
maybe
What's
I
the
would.
next one?
I don't know. I guess I don't know what a 403B is, because my sister said she has one, and I don't think she's got any kids that she's planning.
Yeah, no, Elliot, that was what I had too. I worked at hospitals for 2 years, or 2 years, 2 years each, I guess. So 4 to 5 years total. Both of them only offered 403Bs, so I'm assuming it has something to do with like the structure of the company you work at.
Yeah, I think that's what it is actually.
But I wasn't sure what the difference was between that and 401k.
Oh yeah, Kate just said that. Yeah, it's the nonprofit version of a 401k.
Gotcha.
Yeah, so because actually I didn't. You know what? I should have known this, because I was curious when you said I have a 403B. I was like, really? I thought that was for whatever. And I looked it up, and I didn't even realize that hospitals are considered nonprofits. So that was when I learned hospitals are nonprofits. And
We all know that's not true.
Yeah.
Well, they're actually.
Fair.
I mean, hospitals are being really negatively affected right now. I read something today about a lot of hospitals are losing a lot of money because discretionary procedures have basically been postponed for several months, and it's kind of a windfall to a lot of insurance companies because they're not having to pay out to hospitals for those procedures. So that we'll see if anything happens with that going forward. But in general, I think that there have been a lot of good remediations from the government in order to stop this from going into a full-scale recession. So, and cheap debt is a huge part of that, and we'll see if that has any ramifications down the road. But for now, I think we'll be okay.
Elliot, I should let you know when I commented on r/Wall Street bets, it was more of a joke. Don't get too excited. It's more or less people either being Neanderthals with the stock market or showcasing their great winnings.
I'm assuming if it's anything on Reddit, it's mostly people being like, "This is the best stock ever."
Elliot, I'd like to say that your button down looks nice.
Thank you. I figured I'd dress up a little bit for this.
I love that AJ tuned in his video just to say that.
When's the next video?
I would like to do one same time next week.
Yeah.
So 7 p.m. on Wednesday.
What will the topic be?
I'm free for the foreseeable.
What will the topic be next week?
Well, feel free to think about it and send me any questions, and I'll try to include those as part of my discussion. Like I said, finance is such a broad field, and investing is such a broad field that I think there were even a few parts today where I wasn't expecting to go down a rabbit hole, but it's so easy for me to, once I start on a certain line, I can just go down that path, and I have to kind of pull myself back. So they're like, the whole point of me saying that is there are a lot of different things that I think I could discuss each week, and it really could be like a never-ending discussion, So please send me any questions, whether that's through text or on Facebook or whatever, and if it's a topic that I think is really relevant, I'd be happy to address it.
Elliot, I have one question for you, not to keep you up, but I just thought of something, if you don't mind.
Yeah.
What are your thoughts on buying stocks in a company with the anticipation that they're about to release a new product that will be successful? So my specific example is that I'm a huge nerd. I love playing video games. I know that Sony and Microsoft are releasing new consoles in December. That's going to be huge sales for the company. What is my hunch stock accurate or not?
That was kind of my point about, you have to make your own assumptions. And you might be more educated than a lot of people in the marketplace about that, because like you said, you're super into gaming and you're very interested in consoles and you know a lot about it. That's kind of a competitive advantage for you. Like, I don't know anything about consoles. I don't video game. So, that's an assumption that you're making about their future, and that's a very necessary part of investing. I think that's a really great thesis to invest on. Whether that comes true or not, that's a perfectly sound investment thesis. That's a great reason to invest in a company.
Okay, cool.
Yeah.
All right, any more questions? All right, well, thanks guys. This was really fun, and I'm glad that I had such a great audience show up today. So thanks guys. I look forward to speaking to you again next week if you're interested.
Thanks
Thanks, Elliot.
Thanks so much.
Night guys.